My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people make friends. I'm just trying to make a little money. My job is not just to entertain, but to educate, to teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Apple won, Fed nothing. That's the score. It's all you need to know about today's trading, as Apple briefly regained its title as the largest company on earth, rallying nearly 3% and helping propel the S&P and NASDAQ to new records. The Dow dipping 35 points, S&P jumped 0.85%, NASDAQ pole vaulted 1.53%. This despite the fact that the Federal Reserve kept rates unchanged at high levels and said they're going to stay high until we get evidence that inflation is more subdued. How did Apple stock and so many other big cap stocks rally in spite of the Fed? Because events have overrun pretty much everything all at once. First, this morning, we got a consumer price index number that was very cool. Much different than we thought. It was a clarion call that inflation seems to have peaked. The actual core increase, 0.2%, was slightly better than the 0.3% we were expecting. If we get some more readings like this, the Fed will have what it takes to cut rates. So many prices fell. Airfares, motor vehicle insurance, new vehicles, communications, recreation, gasoline, eggs, uncooked poultry, including turkey, fish, ham, cheese, veggies, potatoes, avocados, carbonated drinks, milk. The CPI number simply didn't jive with the narrative that the Fed clearly bought in when it started its meeting yesterday. Before the CPI, members of the Open Market Committee seemed inclined to give us no rate cuts this year. But after the CPI, that seemed wrong, and the Fed's now on board with one rate cut by the end of the year, although that could change depending upon the data. Of course, this is just one inflation number that came out in the middle of the Fed meeting. So you can't have a hard line Tuesday and soft line Wednesday. That's difficult. Now, I thought Jay Powell walked the tightrope incredibly well today, basically saying if there are more good numbers like today, then the Fed indeed can cut. If there aren't, it doesn't have to. The economy is gradually cooling. He said it's gradually slowing. It's no longer superheated. That's perfect. Fed policy says no transcripts of meetings will be released for 5 years. We get the minutes a lot sooner, but they're much less illuminating. So we will have no idea who could have changed their mind in response to this number. No matter, this very meaningful CPI reading seems to have caught them totally by surprise. In that sense, the positive event completely overran the negative expectations, causing interest rates to plummet instantly. Which brings me back to the stock market. Because in the last few days, we've seen some good news about big tech that have caught investors by surprise, too. The timing, two incredibly bullish set of events happening at the same moment, produced breathtaking results, especially in the NASDAQ. As surprising as that positive CPI reading was, the back-to-back explosion of good news from Apple and then Oracle was perhaps even more shocking and exhilarating. Apple started it all announcing many different improvements to the next iPhone, the 16, incremental improvements. But when taken together, they amounted to a revolutionary new product that could possibly trigger, I don't know, 1 billion upgrades, given that the new iteration will have AI, and unless you have the 15 Pro or Pro Max, your old phone just can't take advantage of it. Apple stock had run into the Worldwide Developers Conference on Monday, but Wall Street and the press were initially quite negative on the new features. However, the public has more divisions than the analysts or the press, so the groundswell of support from the actual buyers of iPhones shocked Wall Street. Apple's now rallied a stunning 8% since this week began. Staggering. How about Oracle? All right, the big enterprise software play. All right, Oracle actually issued weaker sales and earnings numbers. The headlines look bad, but it has a cloud division. That's right. It has a huge, rapidly growing data center business, gigantic buildings that cater to the so-called hyperscalers. Hyperscalers like Microsoft's Azure, Google Cloud. Both of them have come in with gangbuster orders. Oracle has a backlog of almost $100 billion worth of demand. That's just incredible. And it confirms what the bulls have been saying all along, that generative AI is real, and it's spectacular. Wall Street was blown away, and Oracle rallied more than 13%. Of course, if there's that much demand for data centers, that means there's a tremendous demand for the wares of Microsoft and Google, or they wouldn't have bought into the Oracle data centers to begin with. Now, what goes into those data centers? Well, let me see. How about the Nvidia chips? And that's what the pin action from Oracle took Nvidia stock up more than 3.5%. Oh, another $100 billion in capitalization just added like that. That's extraordinary, especially given that Nvidia just had a 10-for-1 split on Monday. My work on big splits like this one says the stocks tend to churn, to flop, to chop, and go nowhere for at least a bit, as individuals who own Nvidia ring the register on 2 or 3 of their shares of the 10. But I think the overwhelmingly positive news from Apple and Oracle staunched the selling and then turned the stock straight up. Now, if you stay tuned, I'm going to give you a deeper analysis of my Apple stance, and I'm going to do some work on the Nvidia chart. But non-spoiler alert, I continue to hold that you should own both stocks and not trade them. And I am grateful for all the well-wishing thank yous that both Jeff Marks, my partner in the CNBC Investing Club, and I have received for those 2 somewhat courageous stands. Tonight, we got still one more set of great tech numbers, this time from Broadcom. Haven't heard of them, AVGO? It's a $700 billion behemoth that makes equipment for, yes, indeed, the data centers, along with other parts of the tech chain. This company, a large holding for the Charitable Trust, is trading up gigantically after the bell. Now, once again, there'll be plenty of people who dismiss these moves as just tech going crazy. Oh, they're waiting. They're waiting for Procter & Gamble. Coca-Cola, that's got to go. JP Morgan's got to advance. All of them down. And they're harping again on the narrowness of the advance. I'm tired of these people. Interest rates went down on the CPI numbers, and they stayed down when Jay Powell definitely announced the Fed's position. That triggered tremendous buying in what had recently become the moribund housing and home improvement group today. Next thing you know, home builders like D.R. Horton, Toll Brothers, Lennar, Scorch Tire, Home Depot, Lowe's, they burst forth. These are important companies, people, that many people feared would be choked into oblivion by the Fed's higher for longer stance. They'll do much better if it's higher for not quite as long. Oh, and just to be sure, it's no longer reasonable just to say, oh, it's just tech. That's because given the size of these behemoths, stocks like Microsoft, Apple, and Nvidia, they can no longer be dismissed as narrow plays on a single industry as they become the market. I'm not engaged in circular reasoning here, people. I'm saying these companies and those that follow them are so large, so immense in proportion to the rest of the market that if you're waiting for the rally to broaden out before you join in, I literally think what you're doing is you're cutting off your nose to spite your face. So let me give you some bottom line advice here. The 2 most important forces in this market, the Fed and tech, both got shocked this week. I mean, shocked in a positive way. When that happens, you're going to make a lot of money as long as you're in the right stocks. If you aren't, though, or if you're still fighting this move, let's just say, like the legendary Jeff Probst from Survivor, ain't got nothing for you. How about we go to Deepin in Illinois? Deepin.
Hi, Jim. Chicago. I just wanted to hear your thoughts on Pfizer. It's a stock that's been beaten down, but has a low price to earnings ratio, considerable dividend yield, and has been making acquisitions like with
certainly. So Deepin, let's analyze the situation. 6% yield. Okay, with rates falling, we definitely want that. Low price earnings multiple. Why is that? Because it doesn't have a lot of high quality drugs right now, prospects. However, they did buy CGM, which I really like, and I think Dr. Borlich should be given a chance here. It had a big COVID overhang. In other words, I agree with you. I think you can own Pfizer here. Ian in Pennsylvania. Ian.
Hey, Dr. Cho. First time, long time. How's it hanging?
Chill man says fine. How about you?
I'm feeling bullish on life, my friend. Just like a well-diversified portfolio.
I like that positive attitude
across various sectors and expecting great return.
All right, that sounds good. I like that.
I will cut straight to the chase. My position in Colson Coors is redder than your world-famous marinara sauce. Over the past couple months, it's down 25%. Can you please provide me some color as to why this stock seems to be so undervalued? And do you recommend buying, holding, or selling?
I am concerned. I think the company's very good. I like the fact that they fixed a lot of their growth. But you know what? In the last few months, the growth has slowed, and there's no doubt about that. And people have turned hard against anything alcohol. I am not going to recommend an alcohol stock, even though that my wife's in the alcohol business. I have no desire to recommend the stock. Why? Because people have turned on alcohol in this country and around the world, and there's no doubt about it that unless you're in very special formulations, ain't got nothing for you. All right, the Fed and the tech sector have gotten shocked in a positive way so far this week, and when that happens, you are going to make a lot of money if you're in the right stocks. Well, Man Money tonight, I'm diving into how one drug maker's discipline is becoming the key to its turnaround. Then, is Nvidia on track to hit a new milestone? I'm going off the charts to break down its post-stock split action. And later, I'm talking PG&E's top brass on the heels of its investor day to hear what's next for the utility company. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
As we get closer to the second half of the year, I'm a man on a mission. My goal is to help you prepare your portfolio for the next 6 months. And right now, I think that means preparing for a slowdown because there's so many brown shoots popping up across the economy, often in the industries that are the first to roll over. It's part of a Fed-mandated slowdown that continues despite the weak consumer price index that we got this morning. That's why all week I've been highlighting my favorite big pharma stocks, even as we know they are going down right now, as they always do when people are really excited for tech, as they are now. Hey, that's when you buy them. You don't buy them when they're running, okay? Now, few groups are more slowdown proof than the drug stocks. Everybody knows I love Eli Lilly, you own it for the Chapel Trust, but I know it's run a good deal, and a lot of people think, well, wait a second. I prefer something that feels a lot less like a momentum play. I recommended AstraZeneca and Merck earlier this week. And tonight I've got a new one for you that I have been recommending. It's called Novartis. It's the major Swiss drug maker. We've talked about them briefly, but not enough. See, I got to admit, when we started formulating this list of the best opportunities in pharma, I didn't expect Novartis to end up on it. From its peak in 2015 through last spring, the stock's really stuck in a rut. It basically did nothing other than pay a decent dividend. The stock got some juice after Dr. Vas Narasimhan took over as CEO in early 2018. But then it stalled out during the pandemic like so many other stocks. Novartis wasn't much of a COVID play, apart from helping to produce the Pfizer-BioNTech vaccine. At the same time, investors started losing enthusiasm for some of the company's past acquisitions. These guys took a big swing in cardiology when they bought a company called the Medicines Company for nearly $10 billion. Then that's a B, in 2020. But the lead drug acquired in that deal had been a very disappointing launch. After one of their big growth opportunities, an anti-inflammatory drug that they wanted to repurpose as a cancer treatment, ended up failing multiple clinical trials. I mean, just a lot of bad. But that's when Narasimhan came up with this new strategy for Novartis, and that I like. See, he put through a restructuring plan that ousted many top executives, narrowed the company's focus down to its most lucrative end markets like cancer, immunology, and reorganized the whole R&D department, less non-core research, and more compensation for advancing drug trials. He also brought in outsiders with a fresh perspective, like a fellow Ronnie Gal, formerly a very smart drug analyst at Sanford Bernstein, who's now the chief strategy and growth officer at Novartis. Very, very important position for them. Meanwhile, in late 2021, these guys also sold their big stake in Roche, the other gigantic Swiss drug company that could pocket $20 billion there. Huge war chest. 2022, Novartis decided to spin off Sandoz, its generic drug business, which they did last October, by giving their shareholders stock in a separate Sandoz. Again, the generic business is extremely low margin. We've seen that in a lot of drug companies. They do that. Remember, J&J did it with Kenvue. So this was another step in Narasimhan's turnaround plan, a step towards making Novartis more of an innovative growth drug company. After those initial moves last year ended up being a huge year for Novartis, okay, it just all came together. First, the company made major strides with their homegrown drug pipeline. They launched a big prostate cancer drug. It's called Pluvicto, and had some very positive trial results for a breast cancer treatment called Kisqali. Novartis also put some of that war chest money to work, acquiring Chinook Therapeutics for $3.2 billion up front, with up to $300 million in milestone payments. Chinook has a pair of late-stage drugs for a type of rare progressive chronic kidney disease. Now, that deal closed last August. Also, last summer, Novartis announced a small deal to acquire a preclinical stage, meaning you don't have anything that's in the pipe right, you're going to see immediately. At biotech, it was called DX Pharma, which is working with neuromuscular and neurological disorders. As Novartis begins a new wave of takeovers, Wall Street's been very impressed by their spending discipline. At the time of the JP Morgan Healthcare Conference in early January, remember we went out there, we heard these guys were in late-stage talks to acquire a company called Cytokinetics for the exciting cardiology drug it was working on. But, discipline, Novartis walked away from the deal at the last minute because the price tag got too high for Cytokinetics, which saw its stock more than triple in the month before we learned that it was going to be acquired. It even looked like there could have been a bidding war developing with AstraZeneca. Thank heavens. I love Novartis didn't chase one. That was just terrific that they didn't. Shows a level of discipline that they did not have 4 years ago when they overpaid to acquire the medicine company. Instead, Novartis ended up doing a couple of smaller deals this year. In early January, we learned that they're buying a Calypso Biotech, which develops monoclonal antibodies to treat a range of autoimmune conditions. In February, Novartis announced a deal to sell 2.7 billion euros for MorphoSys. That's a German biotech company with a promising cancer asset, including one for a rare type of bone marrow cancer called myelofibrosis. And last month, they found out that they're going to snap up. We found out they're going to snap up a preclinical cancer-focused biotech. Again, that means they don't have anything, no sales here, okay, called Mariana Oncology. It's very, very early. But I like that management's taking a long-term view when it comes to bolstering its new drug pipeline. I know these are all small, but they remember how things add up. That's what matters with these guys. These deals are very important, as is Novartis' success with homegrown cancer treatments, because like many other big pharma companies, this one's facing some nasty patent cliffs over the next decade. Remember we talked about this with Merck last night, Keytruda starting to lose patent protection in 4 years, and they're doing everything they can to fill that future hole. For Novartis, the biggest patent pothole is Entresto. Now, that's a chronic heart failure drug, and this is a huge drug. It did more than $6 billion in sales last year, but we're approaching the peak because generic competition is coming sometime next year. And that's Entresto is just, it's an amazing drug. So I like management, I like the strategy, I also like the recent numbers. Last year, Novartis racked up 10% net sales growth, core operating earnings of income of up 18%, while Entresto sales were up 31% on constant currency basis, not something we can count on for much longer. Those new cancer drugs are growing like crazy. Remember the Pluvicto, that's up 261%. Kisqali's up 75%. They have a multiple sclerosis drug that was approved in 2020, but only started doing well last year after we got some very impressive long-term data on relapse rates. Its sales are up 99%. Novartis reported a strong first quarter in April. Net sales up 11%, core operating income up 22%. These same drugs led the company's growth, with Novartis getting an additional boost from Leqvio, and that is a cardiovascular disease drug that they picked up from the previously hated acquisition of the medicines company. This thing had 139% sales growth on a constant currency basis, in part because Novartis published some promising long-term data on its last August. Even better, and this is what really got things going, management raised its full-year guidance, taking its sales growth target from high single digits to low double digits, and raising its core operating income growth outlook from low double digits to mid-teens. Impressive. What can I say? Novartis keeps delivering, which is why the stock's now up 51% from its lows in late 2022. But you know what? I don't think it's done. I think it's got a lot of room to run. After some stumbles in his first years on the job, Dr. Narasimhan has finally gotten Novartis heading really sustainably in the right direction. Company's more focused, it's more disciplined than ever, with deep pockets to let them develop their own drugs and also make smart acquisitions. The bottom line on this one, for now, the Novartis story is the strongest it's been in quite some time, and I bet the stock's a real winner in a slowdown scenario. Mad Money is back in a moment.
Coming up, a closer look at a member of the exclusive Own It, Don't Trade It Club. Cramer goes off the charts. Next.
Everybody who's watched this show in the past couple of years knows that I have a very simple approach to Nvidia, the semiconductor company that's almost single-handedly powering the accelerated computing and generative artificial intelligence revolutions. I always tell you, it's very simply, to own it, don't trade it. Because if you try to trade it, you inevitably end up outsmarting yourself. Even though Nvidia is an incredible long-term performer, it's also an extremely volatile stock. And if you let these extreme moves go into your head, it messes with your judgment. So I think it's generally a mistake to try to game near-term moves in Nvidia. But I also know that this charitable trust holding has become the most popular and most important stock in the world. We're proud that we got it when it wasn't those. But tonight, we're going off the charts with the help of Dan Fitzpatrick. He's a terrific technician who's the founder of Stock Market Mentor and the host of his own podcast, The Fitz Factor. He's had a tremendous track record this year, and right now he thinks Nvidia has the wind at its back after its recent 10-for-1 split. As he sees it, it's a $125 stock, that's where it is right now, is headed, yes, to $200. Why? Well, first, we've already seen how the markets react to the stock split. I've told you many times the splits tend to enhance the value of stocks that previously had high dollar amount price tags. There's no logical reason for that, but we know it makes regular investors feel more comfortable buying the stock, $100 versus $1,000, to think of it like that, even if the math says it shouldn't. You also sometimes get a pullback right after the split, especially when you're dealing with stocks like Nvidia that just had a monster run. People ring the register on a few shares, they let the rest ride. That doesn't happen to Nvidia. In Fitz's view, if the stocks was going to sell off to increase liquidity, well, that would have happened already. It would have happened Monday. He says you can always tell how the market feels about a company that splits its stock by paying attention to how it trades post-split. This is when you find out if the stock was running because, say, there weren't enough shares going around or because big institutions simply couldn't get enough of it. If it was just a liquidity issue, Fitz said the stock would have pulled back once extra shares are dumped on the market. But if it's something that's beloved by money managers, the stock won't even flinch. It'll just keep going and finding new adherents. And that's exactly what's happening with Nvidia. With the stock down 125, it's attracted the home gamers who didn't feel comfortable buying $1,000 plus stock, and I don't blame any one of you. At the same time, money managers won't sell Nvidia into the split because why the heck should they? They love Nvidia. So with institutions not selling and home gamers doing more buying, Fitz points out that the demand for this stock has actually incredibly increased, even though the stock's gone higher. So I want you to take a look at daily chart of Nvidia. When we checked in with Fitz 2 weeks ago, he told us his 52-week price target for Nvidia was $2,000, which translates to $200 now that it's been through the 10-for-1 split. He thinks it's still headed there within 12 months, although at this point he admits that this price target might be conservative. It's just that slapping a higher number on the stock kind of felt it was ridiculous. Look, you only need to look at this one chart to understand the entire story here. Nvidia just popped above a split-adjusted $100 when the company reported a phenomenal quarter late last month. But no one thought that could still. People really doubted that quarter could happen, and it did. And it's been running ever since, right into the split on Monday, and then continuing into today, where the stock jumped another 3.5% after Oracle reported and implied it might need to buy tons of chips from Nvidia to keep power in its red-hot artificial intelligence data center business. Holy cow, are they putting up big plans? Now, normally after this kind of run, the stock would get overbought, and you would need to ignore it for a while as it digests its gains. So what does Nvidia do for rest? Fitzpatrick thinks it's possible. But if history's any guide, he says the stock can get to nearly 50% above its 50-day moving average before its momentum fizzles and it needs to take a breather. And yes, we're going to go over these right now. Just look at what it's done in the past. In May of 2023, okay, Nvidia peaked at a split-adjusted price of around $40, then drifted sideways. And at that point, the peak was 47% above its 50-day moving average. After peaking, the stock spent 4 months, 4.5 months, grinding out a base and then trickling higher as it kept testing its ceiling of resistance at $50. This period tested the patience of traders because the stock just wasn't paying off. But once Nvidia broke out to the upside in January, it took only a couple of months to double from 50 to 100. This is really rather amazing. This run's been incredible. Before peaking again in March and starting the next base. Remember, this is a $3 trillion stock. And where did the base start? Fitzpatrick notes that this happened when the stock was, yes, 47% above the 50-day moving average. Exactly the same level where it lost its mojo in May of 2023. This subsequent period of sideways trading lasted 2.5 months before leading to Nvidia's latest breakout on big volume. So you see these big volume breakouts. Now, Fitzpatrick says there's actually nothing magical about 47%. The charts are not that precise, and it's probably just a coincidence that this thing has happened twice. But, man, there are tons of chart watchers out there, and they love coincidences. And that's why Fitz feels it's so confident that Nvidia can probably keep running. Right now, the stock's only 31% above its 50-day moving average. If the pattern repeats itself, well, then Nvidia should be able to climb to $140 before it runs out of juice. That's a short-term price target. So Fitzpatrick's betting that the stock runs a bit more before settling into another sideways trading range. So we go here, and then if we had more, it would go that way. You get the picture. But if Nvidia does start to peak at 140, what then? All right, this is cool. Fitz thinks the stock would need to rest for a few months, probably right up until its earnings report on August 15th. That said, he feels pretty sanguine about the situation. Fitz notes that on average, stocks that will split, I'm going to give you these figures. I really want you to put this in your head. Stocks that split will rally 25% over the next 12 months. So the stocks that split rally 25%, and that would put Nvidia's stock at 150. At the same time, he thinks it'll have an easier time going higher now that it's done the 10-for-1 split. I agree with him. Plus, Fitz feels confident that Nvidia will be added to the Dow Jones Industrial Average. In his eyes, it's only a matter of time. There's not a lot of money indexed to the Dow Jones Industrial Average. So I don't think that matters that much, but there are some people who buy a stock when it's added to the Dow. Of course, there'll be objections to a $200 price target of Nvidia, but one of the biggest objections is also the easiest to debunk. If this stock goes to $200, then Nvidia will have a nearly $5 trillion market cap, much bigger than anything in the market. Is that insane? Never happened before. Must be impossible, right? Hey, until Apple broke through the $3 trillion mark a little less than a year ago, that had never happened before either. The best thing about Nvidia is that it doesn't even need to take market share. The AI market's growing so fast that even if it merely maintains its current position, the company's going to clean up. Or as Fitz puts it, Nvidia is the most straightforward way to bet on artificial intelligence. So why overthink it? Here's the bottom line. The charts as interpreted by Dan Fitzpatrick suggests that Nvidia's got more room to run, and even if it pauses after the next leg of its rally, he still sees it's headed for $200. That's why I say, Nvidia, own it, don't trade it. Let's take calls. Let's go to Melland in Michigan. Melland.
Hello, Jim. How are you doing?
I'm doing well, Melland. How about you?
I'm good. Happy for the inflation, I saw today, so we're good.
Fantastic.
And anyway, my question is, as we saw Dell for the last quarter, what should we expect from Dell from the next quarter and future?
Okay, I think Dell is a major enabler of artificial intelligence. It takes the Nvidia chips and puts them into where you need them. Michael Dell was on display at the big GTC conference that we all went out to see. And you know what? This is a very interesting and attractive level because the stock traded to 179, then went down to 131 as people were disappointed the last quarter. I, on the other hand, was not disappointed. I think this is all work in progress, and you should be a buyer of the stock. And I thank you for the call. Let's go to Frank in Ohio. Frank.
Hey, Jim. I'm calling from the great state of Ohio, and you know what? It's the home of the Ohio State Buckeyes.
Oh man, I always love that I love that on Saturday. It always makes you smile. Always. Although Jeff Marks went to Penn State, and he's got that thing going too. The Penn State University. So how can I help you?
Well, my question is about Meta. I've been in and out of this stock, Jim, several times. But it's been consolidating since the February 1st earnings week. Correct. And after the pop-up, So after today's lackluster performance, it was only up about maybe a quarter point for the day. Is it time to unload or load up more of it?
Okay, people are thinking just like you, and here's what the concern is. That the biggest advertisers, among the biggest advertisers were Shein and Temu, those two Chinese companies, and apparently they've cut back from everybody's advertising, and that's putting a ceiling on Meta right now. I think that there'll be other advertisers who follow in, and I also believe that they're going to split the stock, and therefore I think that it's a buy, not a hold or a sell. The Charitable Trust does have a big position in Meta. All right, the charts as interpreted by Dan Fitzpatrick suggests Nvidia can keep powering higher from here, and he sees it going to $200, even if it cools off a bit after this rally. That's why I say own it, don't trade it. Much more Mad Money ahead. I'm sitting down with PG&E CEO to find out what the company's working on to garner some long-term growth for the stock. Then, as Apple shot to a record high this week, am I sticking to my core own it, don't trade it thesis? I'm telling you where I stand on this historic action. And, of course, all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer. For the past year and a half, we've been following the progress of PG&E, the previously troubled California utility that emerged from bankruptcy in 2020 before appointing a new leadership team that took over in 2021. Now, under the leadership of CEO Patty Poppe, PG&E's gradually pulled off a pretty amazing turnaround. While the road's been rocky at times, management has had great execution, avoiding safety issues like the wildfires that pushed the previous iteration of the business into bankruptcy, while also getting back into earnings growth mode. Better yet, PG&E put forward some multi-year earnings targets that would make this one of the best growers in the utility space, as long as I can make the numbers. That's why the stock's been able to rally from $10 2 years ago to 18 and change now. Not the kind of gain you'd ever expect from a regulated utility. But what's the longer-term plan for sustainable growth? That's the question management is addressing tonight as it holds its investor day, right here, the New York Stock Exchange. And here now to give that message directly to Cramerica is Patty Poppe, the CEO of PG&E Corp. Ms. Poppe, welcome back to Mad Money.
Thank you, Jim Cramer. Always good to be here.
Well, first, congratulations on delivering everything you promised since the first time you're on, and then some. You've made people a lot of money. How have you been able to accomplish in what many people thought was the most troubled situation in America?
We started with something we're calling our hierarchy of opportunities. Based on Maslow's hierarchy of needs, first and foremost, safety. Physical safety, financial safety. We started there. We have a simple, affordable model that delivers real value for customers, and that's leading to the decarbonized economy in California.
I feel I've done you a disservice. This is not your first rodeo. When I looked at your background, not just from the fact that you're a Boilermaker, which is really crazy, but that you actually turned around another really troubled utility in Detroit. And you did an amazing job. This seems a similar blueprint.
Well, CMS Energy was a very successful company. I had the benefit of following in the footsteps of another turnaround artist, and he taught me all the right tricks.
Okay.
And so I'm happy to bring all of my lessons learned out to PG&E.
Okay, now, decarbonized energy, affordable and resilient energy, and physical and financial safety have in many ways considered to be, and I know you got the needs, but these have really been considered to be at odds with each other. How do you have a decarbonized energy system and also be affordable and resilient?
Well, we're growing load in California. And that new load is coming from data centers. I know that's captured a lot of attention from investors, but also electric vehicles, Jim. Electric vehicles are selling in California. In fact, one of our counties, 43% of new vehicles sold last year were electric, 43%.
Well, I saw you had a diagram in your deck, which is considerable, which had if it goes like this and if it goes like that. But I thought was incredible is the customer data center. I don't know if we can hold these up and people can see them. We do have an unbelievable cameraman. But the number of the pipeline is ridiculous.
Yeah.
How much power is going to be used for these?
Well, right now we have a request for about 3.5 gigawatts of power to serve these.
What's the equivalent of homes for that?
That's millions of homes.
Okay.
It's a huge addition to the load in California, but it's good load. And so we shared at our investor meeting today that by adding this kind of load, we can actually lower costs for customers by better utilizing our existing assets. This is an incredible time to utilize a grid that currently is utilized about 45%. We can utilize that grid more fully and lower unit cost of energy for customers.
Now, how much do you need nuclear for? I mentioned that because Diablo Canyon has been around for a long time. Obviously, there's some funding issues involving the federal government, the governor, and you. But I would believe that nuclear power in your state is going from be something that the left hated, that maybe in your state is known as being a liberal state, to being really the best way to handle all these problems.
Well, definitely having baseload carbon-free energy, like from our Diablo Canyon power plant, is very important. That today supplies energy for about 9% of California's citizens. Okay. So it is an important carbon-free energy source, and the state extended that plant by 5 years, and we're happy to operate that plant safely.
All right, now on incident reductions, I see the reason I mentioned CMS is that your focus on safety led to a 70% decline in incidents compared to 2008. How is the safety issue right now versus when we first got to talk to each other when you inherited a difficult system?
Yeah, we have improved both our coworker safety in similar performance improvement, as well as our customer safety. We've reduced our wildfire ignitions by over 70%. And that's even when we balance that for high-risk days. People want to say, oh, the weather was good, the weather was bad. We're ready 365, 24/7, and we are showing marked improvement on wildfire mitigation.
Okay, now this is important because there were a lot of people who said that it was an intractable situation. There were other people who said that because the way the trees were cleared, it was the fault of the utility. Other people said it was just nothing you could do unless everything was buried underground. A lot of these things turned out to be false.
Yeah, we do think that undergrounding power lines is a piece of the puzzle for about 8% of our lines, so a very small percentage. But we also think that our layers of protection, we know, have made customers safer, have made our community safer, and for investors, and this is important for your audience, Jim, there are protections in California now that protect investors when there is a catastrophic wildfire. So our legal construct in California has changed dramatically. That provides financial protections for investors so that we can attract capital to invest in the infrastructure that is prepared and climate resilient.
Now, when people talk about the tremendous demand for data centers, I know we spoke to Coterra Energy last night. They were talking about how some of these big, the titans of tech will have to actually make deals with natural gas companies to be able to provide all the power. What do you do with the tech titans who want to build in your state or want to have more within your state, but they're not really fitting in your plan?
Well, this is why we're so excited, first of all, to serve the heartbeat of innovation of America. We serve the Silicon Valley, the Bay Area. We have great data center demand.
Right.
And we can serve that by, again, as I said, more fully utilizing the grid. We'll build infrastructure to serve that is clean. Already on our wires, we're over 60% clean energy being delivered to those data centers today. So they don't have to invest as much to make sure they get that clean energy resource that they want. It is beneficial load for all customers.
Well, when we come out there in September, will you take us to a data center and a power plant so we see what the heck we're getting into here?
We will, especially one of our transmission substations, which is really important in California because we transport a lot of energy, and we are the transmission company of Northern and Central California. So we would love to take you.
All right, well, I'm going to bring my hard hat, and you'll take me around, okay?
I'll keep you safe, Jim.
Congratulations on delivering everything you said you would and more. That is Patty Poppe, the CEO of PG&E Corporation. Guys, this is a growth utility. I don't have many of those in my book. Mad Money's back after the break.
Coming up, pop open those umbrellas and tee up your toughest questions. Cramer takes on all comers in the lightning round. Next.
It is time. It's time for the lightning round. Play this out. And then the lightning round is over. Are you ready, Ski Daddy? Time for the lightning round. Let's start with Sam in California. Sam.
Hello. Jim, I just wanted to find out if you've heard of this stock called A-Lab.
Yeah, Sir Labs. They came public not that long ago. I think it's a good story, not a great story. I mean, ARM came public at the same time. I think it's a better story. But I'd rather have you stick with something like a Broadcom, which is still cheap, even after this remarkable run that we experienced just this evening. Kevin in New York. Kevin.
Hey, Jim, a big booyah from Buffalo.
Buffalo. Hey, my friends at B-Bouts from Buffalo. That's why I like the town. What's going on?
Love it, love it. Hey, me likey dividends, but talk to me about BTI tobacco.
I'm not going to recommend tobacco companies. Hey, life's too short. And they help make it that. Let's go to Jason in Maryland, please. Jason.
Hey, Jim, got a big Baltimore Obey booyah for you.
Hey, man, I'm a big Raven fan myself, kind of. What's going on?
All right, man, love the show. My question is about ticker TXN, Texas Instruments.
You want to buy Texas Instruments. You got Elliott Partners in there. You've got a very good management team that's been a little bit too arrogant. I think together the two are going to end up having a stock that is higher. Let's go to Drew in Connecticut. Drew.
Booyah, brother Jim.
Booyah, partner. What's going on?
Well, I'm rooting for a Yankee-Philly World Series.
Hey, why not? A replay of 2009 without Utley. Let's see what it's like. What's going on?
Let's do it with the pinstripes. I want to ask you about the variable dividend and Devon Energy.
Okay, I mean, Devon is actually not nearly as good as it was a couple years ago. I hate to say it because I really like Rick Muncrief. I do prefer you to be in Coterra. CTRA, that's a better one. Or Diamondback symbol, bang. Let's go to Gary in New Jersey. Gary.
Jim, good afternoon. Thank you for taking the call.
Of course.
Love the show.
Thank you.
My question is, I bought this stock 2.5 years ago, post-split, at $335. It was going down. You recommended buy it. I got more at $250. Now it's at $428. Should I hold it or sell it? Intuitive Surgical.
Oh, no, we like ISRG very much. I've liked it ever since did a fundraiser for a local hospital because they got one and just been incredibly impressed. And every time it's been down, I slam this button because it's that good. I need to go to Joel in Florida. Joel.
Hi, Jim. Thanks for taking my...
Of course.
At a bigger bank several years ago, you recommended Skyworks Solutions at $6 a share, which I kept pyramiding up and was shocked that it got all the way to $200. And then I thought, well, I better lighten up, so I sold a lot of it. But the remaining shares I have, it floated down to, I think, around 90. So my question is, do I hold on to those remaining shares?
Yes, you definitely hold on. Actually, I even want to buy. Dave Aldrich was there when the stock was at $6. He did a remarkable job, got all the way up, and then put Liam Griffin. And Liam's terrific, other than the fact that he's a Patriots fan. And I do think that the stock's about to have a big move. Why? Because Apple's going to be placing big orders within a 1 or 2. It's a buy. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab.
A truck driver stopped me yesterday when I was on my way to a checkup at NYU Langone over 38th Street, Manhattan. He rolls out the window and he says, "Hey, Cramer, Apple, own it, don't trade it. Thank you." I shouted, "You're welcome." You'd think that just owning Apple would be an easy win. But it's insane how hard it was to actually catch this massive move in the stock that was the largest company on earth for most of today before Microsoft reclaimed that title close to the close. See, my mantra is own it, don't trade it, because I know that Apple's a superbly run company that's always committed to being the best at what it does. That means you have to stick with the stock during tough times. Because, see, you never know when the bloom of greatness will surface again. Owning it is the better strategy. Let me prove it to you. Let's look at the research work of Gil Luria. He's a very good analyst who covers Apple for D.A. Davidson. On January 2nd, with the stock at $192, Luria stunned the street. He rolled out coverage of Apple with a hold rating, not a buy like almost everyone else, but a hold, and a $166 price target. That's 26 points lower than where the stock was. He's an Apple apostate. His argument, quote, the current share price reflects expectations for significant resumption of growth, which is less likely without an innovation breakthrough, end quote. More broadly, he goes on and says, quote, we await Apple to get unstuck on the innovation front in order to generate upgrade growth in its existing products and add through new products, end quote. Luria did talk about the possibility that there could be exciting generative AI applications, but at that moment, it didn't seem like Apple had anything special to him. Then the stock then drops from 192 to 181 in 3 days. So far, an amazing call, right? At the beginning of February, with the stock at 186, he issues another report. Still a hold, still price target 166, saying he can't upgrade after a mixed first quarter, which saw, and he quotes, I quote, further deceleration in China's sales growth, end quote. The last line of this news report shows the real tension here. Quote, we believe that while commentary is limited, Apple has an incredibly compelling opportunity to create new, innovative, generative AI products, end quote. He wrote that he expects to hear about the generative AI plans, quote, which will likely occur at their annual September event, end quote, emphasis mine. Then on April 19th, with worries about China and the slowing service revenues, the stock does indeed drops to 165. Yes, dollar below his price target. Bingo! Does Luria upgrade the stock, though? Did he nail it? No. See, he does nothing. Nothing at all. He doesn't upgrade. Apple then starts its relentless climb back to 196, where it stood on the eve of the Worldwide Developers Conference, which was on Monday. That's 4 points above where it was trading when Luria initiated coverage with a hold and a much lower price target. Now, that's not unusual, as this meeting is supposed to be a nothing burger. But you see, it didn't work out that way. Apple chose, surprise everybody, introduced its new AI capabilities at the Worldwide Developers Conference this past Monday. Initially, Wall Street didn't care for the presentation. Stock sold off. And that's when Gil pulled the trigger, upgrading his hold to a buy. He scraps the 166 price target that had been hit, but he ignored it. And then he slaps on a $230 target. Why? Because, as he put it, there are some important new features, but, and I quote, the critical piece of information was that the functionality will only be backward compatible to iPhone 15 Pro, which means it could at last lead to a much-needed iPhone upgrade cycle, end quote. Good call, as Apple's now rallied to 213. But think about what happened here. He starts with a hold at 192, calling for the stock to fall to 166, because there's nothing near-term that can cause an upgrade cycle. The stock then drops like a rock to 165, but he doesn't upgrade down there. He only goes positive when the stock's rebounded above where it was trading when he initiated coverage with that bold hold call. And even then, he only does it because Apple rolls out the compelling new features he was waiting for that weren't supposed to happen until September. Only then, in a total round trip, does he say buy. And that's why I always say own Apple, don't trade it. We never know when Apple will announce some compelling new features that create a new upgrade cycle. I just have faith they're coming. And look, I'm not trying to criticize this one analyst. Gil nailed the thing to a T, didn't he? But when the stock took out his $166 price target, he didn't switch. I don't know why, but I'll tell you this. There's no truck driver thanking this guy for own it, don't trade it. Because in the end, he approached it like a trader and missed out on almost all of the recent upside. I like to say there's always a bull market somewhere, and I promise to try to find it just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow. Last call starts now.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.